all the horrible experiences that I had with investors made me want to become an investor, because I knew that there were a lot more people who looked like me who were probably having similar experiences. And as I started to talk to more people, I heard from them that they were also having some of the crazy, primarily from women. I was hearing a lot of wild experiences that they were having with venture capitalists. And so I kind of made a vow to myself that if I ever got on the other side of building my business, that I would become an investor.
What's up, guys? Welcome back to the More Rounds podcast. I'm Kim Lewis, CEO and co-founder of CurlMix. And today, you guys, we have one of the pioneers, one of the best in the land, okay? Jewel Burks here with us today. She has sold her company to Amazon. She has launched a fund, one of the few Black women to raise a fund over an X number of dollars, invested in so many Black and female founders. Many of my friends, some of the folks who have been on this podcast, like Tracy Pickett. I love Jewel, and I'm so impressed by what she's done and inspired by her. And I am excited to have her here to tell you her story. Okay. But before we get started, we got to cheers first.
Cheers.
All right. So you can take a sip if you like, but I'm going to take a sip and then put mine down. Okay. Who is Jewel Burks? And what's your background? I want to get into your fun story, how you raised money for Collab Capital later. But I would love to know kind of how you got started, take me through that timeline, and who was Jewel Burks?
Yeah, so I always like to share with people that I was born into entrepreneurship. My parents were entrepreneurs, so I got it honest. I grew up watching them build their businesses. I saw the struggles, the ups and downs, sort of every part of what it means to really be an entrepreneur. And so for some odd reason, I decided that I wanted that life too, and always knew that I was going to build businesses. So I went to Howard University, majored in marketing.
HU is producing like a bunch of, dope entrepreneurs. Okay.
Yes. But, wanted to first get some experience. So started my career, interned on Wall Street, so got that experience, and then but that was in '08, so not the best time to be starting a career in the financial services, if you know what happened during that time.
Yeah.
And then decided to go into tech. Actually, Google was on campus. I heard about they were offering an internship, so I interviewed and got the internship. And that was kind of how I got into tech. And I moved out to Mountain View to work, and I completely fell in love. I thought, man, this is so fast paced, so much going on. And I really just wanted to be a part of that. So ended up actually graduating from school early so that I could go back to Google full time. And then, just got deep into what was happening. I wasn't an engineering student. I was, like I mentioned, a marketing major. But I knew that being close and proximate to folks who were building technology was what I wanted to do. So did that, and then had some family stuff happen and ended up needing to move closer to home. So moved to Atlanta, which is kind of equidistant from my mom and my dad and grandparents, in Mobile and in Nashville. And then started working at a parts distribution company, which was a far cry from Google, very archaic in their technology. But came up with an idea while I was there to bring technology into that industry. So started a company called Part Pick, which was visual search for replacement parts. And then that really was how I really entered into tech entrepreneurship specifically.
And then you started Part Pick, and then later sold it to Amazon.
Yeah.
Right. When did you know that you wanted to raise a fund with Collab Capital?
So I knew I wanted to become an investor while I was building Part Pick because of all of the interesting and interesting is a nice word. All the horrible experiences that I had with investors made me want to become an investor, because I knew that there were a lot more people who looked like me who were probably having similar experiences. And as I started to talk to more people, I heard from them that they were also having some of the crazy, primarily from women. I was hearing a lot of wild experiences that they were having with venture capitalists. And so I kind of made a vow to myself that if I ever got on the other side of building my business, that I would become an investor. So I knew probably year 2 of building Part Pick that when I got done building, the next thing I wanted to do was invest. And so luckily I was able to sell the business. I had some liquidity, had some money, so that I could start angel investing. And so that's the first thing I did. I started meeting with founders, getting to know what they were working on. And that was really my way of getting out of a little bit of a depression around selling my business earlier than I anticipated.
How long were you doing Part Pick?
It was 4 years.
Okay.
Yeah. So I started in 2012 and sold in 2016.
Okay.
So yeah, that experience, I had $1 billion aspirations in building my business. And unfortunately, because of how fundraising was for me, I took the offer to sell to Amazon probably earlier in the life cycle of the business than I wanted to. Ultimately, it was a great outcome. Everything I'm doing now, that was the platform for it. But because of how challenging fundraising was for me, I feel like I didn't get the full shot at building what could have been a much bigger business. So yeah, that's what's motivated me to become an investor now. Like I said, initially angel invested, learned a ton, met incredible founders, got a chance to put to work my own capital, and then quickly realized, and after conversations with my financial advisor, realized I can't be spending all the money that I made on angel investments. So decided that I wanted to really formalize my investing and start a fund.
Okay.
And I was having conversations with a couple of my friends at the time who were similarly situated as far as they had built businesses. They were kind of figuring out what they wanted to do next. And we were all coming to the same conclusion that we really wanted to make sure that the next generation of founders didn't have the same struggles that we had.
Man.
So that's how we started Collab.
So how long was it between you angel investing and when you got your first big check for Collab?
So my first angel investment was in probably early 2017. And our first check-in for Collab was 2020, 2019, 2020, somewhere in there.
So it was like 2.5 years before
probably 3 years. I think our first checks in for Collab were 2020. So yeah.
So were you spending those 3 years like just meeting as many rich people as you could to get checks? Like how are you? It's like a mystery. I don't think founders ever think about what it's like for a VC to raise money. I think we just think, okay, I'm building this great business. I want to build something amazing. I need funding for it. Okay, I have to raise money. How do I raise money? Oh, I talk to people. Blah, blah, blah. Okay, this is how I raise money. And let me go talk to VCs. They never think how the VC got that money in the first place. They just think it's yours. You know what I mean?
Oh, it's not. Yes, I think I was a few things. I was keeping my investors from Part Pick updated on how things were going with the transition into Amazon. So I would send them kind of, maybe quarterly or biannual updates on, this is what's going on as far as the integration. Here's what I'm thinking about for what's next. I let them know, like, I've made my first few angel investments. So that was one kind of bucket of people that I was keeping in the loop as far as what I was planning on doing next. And I told them, they were probably the first to know that I was planning on starting a fund. And then, I just continued to network. I think I drew more attention once people realized that I had sold my business to Amazon. I think I was kind of an underdog in the venture world. And so once people saw like, oh, you built something that Amazon wanted, of course, that attracted more people to try to figure out what I was going to do next. Because oftentimes venture capitalists, they want to bet on your second thing if you've been successful in the first thing. So a lot of people were trying to figure out if I'm going to start a new business or, what exactly am I going to do next? So that was another kind of pot of people that I was keeping warm and letting know, oh, I'm going to actually start a venture capital fund. I also was just going to events, getting out there, networking, meeting people. And then I also took on another role. I was leading Google for Startups shortly after I left Amazon after 3 years. So I had a few things that were going on over the course between 2016 and 2019 to start to get people interested in what I was going to be doing next. And I think that made it easier when I actually went out and said, I'm going to raise a fund. Those first few conversations, people were excited to back what I was going to do next, given the success of the first thing.
And, starting a fund, people think that like, okay, well, some rich person just wrote you a check and like now you have a fund. It's my understanding that you have to like have filings with the SEC, right? About like the information around your fund and like reports. What does that look like? At what point do you do that when you start a fund?
Yeah, it's definitely not just someone writes you a check. Well, maybe for some people that's what it is, but for me, that wasn't it at all. It was actually a year of trying to figure out if we were actually going to start a fund. So I have two partners, Barry Gibbons and Justin Dawkins, and we all knew that we wanted to do something to get capital to entrepreneurs, but we didn't necessarily agree on what the method would be or what the structure would be. Each of us had our different experiences with investors, and honestly, all of us didn't really like those experiences. And so we were reluctant to build a fund because the connotation with that is that we would become venture capitalists, and we just said we don't like venture capitalists. So
be the very thing that you hate.
Yes.
When your idols become your rivals.
Right. So we were very reluctant to pursue that particular path. And so we spent literally a year going back and forth about what it is that we wanted to build, what would the structure be, how would we do it differently to make sure that we weren't becoming what we didn't like. And we really, we were in the lab for just like entrepreneurs, kind of figuring out how we wanted to build it. And what we ended up with is that we did want to build a fund, but we wanted to do things differently. So even the structure that we have at Collab is a bit different than your typical venture capital fund. The LPs that we have, the limited partners, our investors are, I would say, probably more diverse than your typical fund, mostly because the first $10 million that we raised, primarily we raised it from individuals, entrepreneurs, operators, people who we knew could come in and be helpful to the businesses that we invested in. A lot.
And for real quick, tell me how much you raised overall for Collab Capital.
So Fund 1, we raised just over $51 million. Currently raising Fund 2 with a target of $100 million. Whew. So yeah.
Congrats, Jewel. I'm, as a Black female founder, VC, all the things, like, I know how hard it's been to just raise, period, right? And so to be like, our fund is $50 million and we distribute that and we're on Fund 2, and we're targeting $100 million. Whether or not, I don't know if, you get there, maybe you raise more than $100 million. Maybe you raise $200 million. Who knows? Yes. Like, and that was not a doubt to you at all. It was just like, it doesn't matter. Like, what you've done is enough. And like, it's incredible.
Thank you.
I'm proud of you.
I appreciate that.
Truly, and inspired by you. You have for founders who see an exit, which we are so few of us actually get to the exit, which that is the goal, right? To then go on and do something else like launching a fund and raising $50 million or more. That's just incredible. So very, very impressed by you.
Thank you.
So at what point did you guys do the filings with the SEC? Is that hard? Is that like how in crowdfunding we have a Form C? Like, what does that look like?
I think hard is relative. I feel like a lot of stuff in this business is hard, but it's just what you have to do to be in business. So you got to get a good legal team. We have a great one, Townsend & Lockett, Black-owned firm out of Atlanta.
Okay, Black-owned.
Yeah.
Okay, Atlanta.
So yeah, they obviously took a lot of the work related to all of the filings off of our plate. But I would say more than just the filings, because again, that's paperwork. I don't think that's necessarily hard. It's just like what you have to do. The structure of how we wanted to put together the firm, the institution building, I think is the harder part. Okay. Because if you think about venture capital, it's about a 60, 70-year-old industry. Mm-hmm. And there are firms that have been in business for 50 plus years. And this is not like we raise a $50 million fund and then we go away, or hopefully that's not what happens. We're talking about decades that we are trying to build up a business in. So that I think is the harder part of making sure that we have everything, the foundation set, so that we can build something that can be longstanding over many, many decades.
Do you think, I have an interesting question. Do you think that VCs who are not previous founders who had an exit are as valuable as VCs who are previous founders with an exit?
I feel like this is a little bit of a controversial question.
It is controversial, but I have my opinions, but I'm not a VC, so yes. I would love to know from your end.
Okay, I'll take it two angles. One, just looking back at my founder experience, I will say the investors that I found to be most helpful were those who had operated previously. Okay. And then from what I hear from the founders that I've invested in, as compared to their other investors, I think we tend to be a little bit more helpful just because we know exactly the shoes that the founders are in.
Yeah.
Our experience, I mean, I built my business 10 plus years ago at this point. So the things that I experience are not exactly the same as what a founder today is going through. But I think the empathy that I have for what it is like to be a founder is valuable. It could be argued that folks who have more of the financial experience or maybe, coming from private equity or more traditional VC background may be helpful on certain aspects of the business that I may not be as helpful on. I think for entrepreneurs, it's great to build a team of people who have varied experiences. So there's no problem that somebody that's in your will or in your network hasn't seen.
Yeah.
But I would say, I think it's an advantage for sure to have been in the seat of an entrepreneur and now be an investor because I can kind of see all sides.
If you are a Chromex investor, meaning you invested in our crowdfund last time or this time, we need you to wear your investor tee that says Chromex Investor to Ulta on September 17th and take a picture with the products on the shelf. Yes, get a shelfie and post it online with the hashtag Chromex Investor. We want to see you and your beautiful smile. Now back to the episode. So you've been in this entrepreneurial VC game for like a decade now, right? You've seen founders come and go. You see founders blow up. You see founders stay in the same spot. Is there something that the founders who are winning are doing differently than the founders who are not?
Yes.
Okay. What is that? What is that?
There's several things. The things that stand out to me are consistency and focus. I think it's so easy to get distracted in this business. In the business of building a business, it's very, very easy to get distracted. There's a lot of trends that come and go. There's a lot of things that seem to be important, but really are not going to make a difference in the business. So typically, to me, the founders that are most successful have a crazy focus on exactly what it is that they're building.
Can you give me an example of like what you think is like consistency? Like an example, a story or someone?
Do I want to name people? Let's see. Well, okay, I'll give you an idea. The founders, I have like 15 angel investments from before I started Collab. And the founders who have performed best out of my angel investments have been the ones that are extremely consistent with their investor updates. So on at least monthly, in some cases, more regularly than monthly. I have one company that does like weekly updates, which is a lot, but
how big are they that they're doing these like weekly, monthly updates?
I have 3 companies that I'm thinking about. They're all at the Series B stage. All have raised $40 to $50 million. All are doing tens of $millions of dollars in revenue. All are valued at hundreds of millions of dollars. And they're still consistent. Some of them maybe have gone to quarterly.
What do these weekly updates look like or monthly updates look like? Is it just like an email or is it like a deck or like it's very simple?
It's all, most of them are emails. Some do videos from time to time, but mostly they do emails. And they also have financial packets every quarter. So they're talking about challenges in the business, and highlighting challenges in the business. That's really important because a lot of times founders think you need to just give your investors the good stuff, but actually your investors can be most helpful when they know what's going wrong in the business and they know it before they can see it. You should tell them before they can see it themselves. So that's one thing, challenges in the business. Morale, that's become more of a theme in the updates of like team morale. How are things going with the team? Financials, that's upfront. Where are we from a cash position? What's our revenue look like? What's our churn look like? Those are kind of this consistent theme. What's growth? What's happening as far as customer acquisition?
And at this point though, you're an angel. So like they don't have to share that information, right? Like it's not that you wouldn't, but I mean like at this point they probably have a formalized board. They're responsible for giving their board certain data every quarter. Yeah. Like what makes them...
Why do they do that?
Yeah, like, because it's just a lot of work, like, to be like, because then also you can't be doing not anything else, but like, if you're sending, weekly, monthly update, maybe I'm telling on myself, I'm learning here. I'm like, teach me though, I'm learning. All right, so this is, this is a podcast episode for the audience, but obviously I'm getting my consulting. So,
So I think monthly updates, weekly is a bit much. That particular company, they were going through something pretty challenging, and they needed their investors to be understanding what's going on, because it was something that was kind of getting it was getting pressed. So they needed people to be understanding what was happening. But monthly to me should be across the board. And the reason that they're sending it to all of their investors is because they want support from whoever has a stake in the business. So even though I may have put in $25,000 5 years ago, I still have connections at Google. I still, can make introductions for them to later stage investors. There's still things that I can do. Yeah. And I want to do, because now it's like, any company I'm invested in, I want to be successful. Mm-hmm. So whatever I can do, even if it's a small thing, I want to be doing it. But yeah, that to me, and I know some people don't believe this, but I really think consistent updates is just a critical thing to do. And not only for the investors, it really, for me, when I was a founder, I did it because it helped me remain accountable to what I said I was going to do. So if I said in a monthly update, this is what we're going to do next month, that was just motivation for me to hit that target so that I could say in the next month, we hit it. And here's what we're going to do next month. So I think it's an accountability thing. I think it is also just a great record to keep as far as the progress of the business over time and how you're thinking about the business. A lot of times I feel like writing out your thoughts is super helpful for clarity. So there's a lot of benefits to it. I think I wrote a blog post about why I think people should write monthly updates. I'm very passionate about this.
And it's totally not self-interested. With Jewel just needs to know everything that's going on.
No, it's not.
I'm joking. I'm like, you make very solid points. Very solid points.
But I think another thing, one last thing I'll say about this, because it is a little bit of a contentious point between founders and investors. But the other thing is, you want your investors to have the latest and greatest information about your business so they can speak to your business when speaking to other people. I was telling some of the founders that I'm invested in, my founders that I've invested in are like my cocktail conversation. You know what I'm saying? If they're top of mind, if I've just read an update, it's who I'm talking about when I meet anyone I think will be relevant to their business. Yeah. So that's another reason. It's honestly, it's selfish of like, I just want you to know what's going on so you can talk about me more. That's really the reason. So
the founders that are performing the worst in your portfolio, what's some common threads amongst them?
Lack of focus, getting distracted, doing everything.
No, I'm kidding. I'm totally joking.
I think there are, particularly if you're in a consumer business, there are many reasons to do a podcast, get out there, let your customers see you.
Media, yeah.
I think that it makes total sense. Now, if you're in a enterprise, if you're selling to enterprise, do you need a podcast? Maybe if it's very specific to your customers, but I think a lot of people get caught up in the flash of entrepreneurship and they miss the fact that you have to be building a business that's making money and doing it profitably. Eventually, that's the goal. Yeah. And all the other stuff, if it's not driving toward that, then it's a distraction. So I see people, getting hyped up with the lists that they made or the awards, and all of that is like, look, I know your numbers, and your numbers really not looking like that.
So I saw that P&L, that negative EBITDA.
Yeah,
I know you got that award, but
yeah. So that's what I see of the founders that are not doing as well. And then I think the other piece is getting caught up in fundraising. Yeah. Fundraising can be a big distraction if you let it. Yeah. And if it's not means to an end as far as inputs going to growth, then you're just raising a lot of money and then the business has nothing to show for it. And so that some people get really good at fundraising and they take that to mean that they're good at being an entrepreneur. And those two things are not one and the same.
Okay. Oh, you gave me a lot of, so my question typically is like, that's an unpopular opinion that you have about fundraising, but you just gave me so many, contentious points between, I have a different question for you. What's something that you think entrepreneurs need to hear? Like, you get a lot of people asking you for money all the time, and You know, and I feel bad sometimes too, because like I know you, Jewel, from like a human perspective, like from a personal perspective. So I never feel like if Jewel tells me no from an investment, I'm just like, okay, cool, whatever, girl. Like if you want to still want to go to lunch, like I don't take it personally. But sometimes, you know, people that no hurts, you know what I mean?
Yeah.
And so, and then they associate that no or that feeling that you gave them or whatever with you as Jewel the person, and that it's just really not who you are. Mm-hmm. And so, and that was just why I kind of feel bad sometimes from a VPC perspective, because people will paint whatever image based on that no.
Yeah.
But is there something that you want like founders to know? People who are approaching you, people who want, you know, deals, people who want a check from you. And you say you're raising $100 million fund. Is it the same thesis that you had with the first 50 million, or is it a different thesis? Sorry, there's a lot of questions.
Yeah.
In there. My bad. I'm sorry. I'm working on my hosting.
Okay, so I'll take it apart. The first thing is, what do I want founders to know?
Yeah.
I think I really want people to understand capital and the different types of capital that could be available for their business, and matching capital with their business. So venture capital has a very specific purpose. It's gotten very muddled over the past 5 years, where it's been applied to consumer businesses. It's been applied to businesses that are using the venture capital to pay for ads. That's really not the intention of venture capital. And that messes it, in my opinion, it messes it up because it's a mismatch. Venture capital traditionally is for high risk businesses with either a high amount of research required or a high capital expenditure from the people standpoint, meaning you have to pay for very expensive engineering talent, and high margin. So that's kind of the risk reward, is that you're going to get into a business where there is some type of repeatable model that's going to have a high level of margin, which is why you see venture capital typically for software businesses.
Yeah. But like, doesn't like 60% of VC money go to like Facebook or something like that?
That is that is what has happened, but that's not the intention.
Okay.
You get what I'm saying?
Okay.
And something else to know, and I don't know if we have the time to go into all this detail, but I think it's really important for people to take apart what's happened over the past 4 or 5 years in the industry versus what the actual intention of the capital and the way that it actually works. There's been there's been a lot of cheap money circulating over the past 5 years. Of course, now we're in 2023 and the landscape is completely different.
Yeah.
But I think people are still operating with the 2021 mindset, thinking that, oh, this company raised this amount of capital, I should be able to also. Yeah. And that's just not the case. It's just not. So it's important for founders to understand.
What's the difference between 2021 and 2023?
2020, let's say 2021, and maybe I'll go back even further, 2019, just capital was cheap, very flowing, markets were doing great.
Easier to get. People were able to raise money in a much easier fashion off of ideas that, or even solutions that really just are not a great fit for venture capital. Yeah. When I say that, I don't know if I'm really explaining it well, but one thing I want founders to think about is the cost of capital. Venture capital to an entrepreneur is very expensive capital because you're giving away equity in your business early and you don't exactly know what it's going to be worth in the future. Yeah. There's other types of capital out there that don't have the PR that venture capital has, that are actually a lot more affordable for your business. And oftentimes you know exactly what you're going to have to pay for it in the future. Debt, you know exactly when you sign up for it, you know what you're going to have to pay. Yeah. Sometimes businesses can't afford it depending on what their cash flows look like, but getting smarter about the types of capital that are available and how that matches with your business model is something that I want for all founders to do, because I think people just think, oh, I started a business, I need to get venture capital. Yeah. And venture capital is for less than 1% of businesses from a business model and type perspective. Yeah. And also a risk perspective. So that's something that I want founders to know. How that translates to my role is that, yes, I have to tell a lot of people no, because I am in the venture capital business. Yeah. And although we have an interesting model
where we've brought profit sharing into some of the deals that we do. By and large, at the end of the day, any company that I invest in, I have to answer a question of, do I believe this company is going to be able to return the fund? And what that means is at an exit, at a future sell or IPO, do I believe that with this investment, I will be able to get $50 million in Fund 1 or $100 million in Fund 2 back from this investment? So if you do the math on that, that means that I'm investing $1 million. I need that company to exit for $1 billion, $2 billion in Fund 2 in order for me to get my original investment back times 50 essentially for me to return the fund.
Yeah.
So that type of math is important for founders to have a sense of, because I'm not telling you no because I don't like you or not even because I don't like your business. It's really a math equation that I'm doing on my side that I have to underwrite for every investment that I do. And that
is that because it has to be a 10x?
That's because we're in a business of bets. If I make typically 40 investments in a fund, my calculus is that maybe 4 out of 40 of those companies are going to be able to return the fund. Mm-hmm. I'm hoping that more
and that will give you like a 3x return
on the fund.
On the money.
Yes,
yep. Okay.
Exactly. And that's what I owe to my LPs. So I'm not successful in the business that I signed up for if I don't return at least 3x of the money of the 50 million. So 150 million is what I need to get back in order to.
And 2x would just be like 3 founders, and then 1x would be, 100. It would be 2 founders.
Yeah, I mean for rough math.
Yeah, rough math. Okay, rough math. Gotcha.
What's really going to happen is some founders are going to return, just flat. If I gave them $1 million, they'll give me $1 million. Most founders are not going to return anything, or they'll return less than.
Yeah. It'd be like that.
Yeah, I mean, that's the reality. Business is hard. This stuff is not easy. So that's the expectation when we go into an investment. Obviously, we want the investment to do well. We want the founder to be successful. We want to get our money back. But the reality is there's so many things that can happen along the course of, a 10-year relationship is what we're really signing up for when we write that check.
Yeah.
And there's so many things that can happen. So generally, however, I have to be able to underwrite at the onset of the investment that this is what I expect we can do. And if you come to me and you say, my market is, I'm in a market that's, if I get all the customers, it's $100 million market. Well, then I know we're not going to be able to, I can't underwrite that. It's too small.
Yeah, it's too small.
Or if you tell me that you're in a business where you have to sell to your customers, each customer every single time, like you have to acquire new customers every single time.
Yeah.
Then I'm like, the cost on that is going to be too high. We're probably never going to get to profitability.
Yeah.
So those are the types of things I'm thinking about. And again, it's nothing against, and I think this is a struggle for entrepreneurs to recognize, it's nothing against you or what you're building. It's literally, I signed up for a certain target that I have to hit in order for me to be successful at my job. So that's what I'm thinking about when I'm evaluating any business.
Okay. I have one final question. Are there any, you've gotten this one before, but I just have to know selfishly, are there any investments that you've people you passed on that you wish oh dang, if I could go back, I would have invested, a little bit of money here, a little bit of money there?
Absolutely. There's many, but the one that always stands out, and I've told her this, she knows this, and I've been trying to make it right ever since.
Not make it right.
is Savisha Wilson.
Oh.
I had an opportunity to invest in her pre-seed round.
Oh.
And I talked to her. I thought she was amazing from the first time I chatted with her, but I didn't believe in the market because she sells to nonprofits, and I didn't think that the market would be big enough.
I can see that.
Or that they would just have the money to buy her product. But this is an instance where I veered a little bit from my typical way of investing, which at the earliest stage, which is bet on the founder, which I should have bet on her all day. So I say I've been trying to make it right because I've, recommended her for different things. And, she is now a friend.
Yes.
And she's actually an LP in Collab. So she's
that's dope.
Yeah. So we're good. Luckily, she didn't hold it against me that I didn't invest, but that's one that I think, that was a mistake.
That's a good one.
And yeah, I mean, generally bet on Black women all day. So yeah.
What I can say is that, like, because so many of our Black female founders that I've like come up with, we want it so bad, it's at all costs.
Yeah.
Even if we losing our houses or like eating ramen noodles. Like, I'm not saying that's what we should do, but I'm saying that's what many of us are willing to do to not let our business just die.
Yeah.
And so and I know that there are other people who are like, I would have quit that a long time ago. You know what I mean? Just start something new. Sorry, investors. Sorry, so-and-so, you know, but that's not how we roll. So, Jewel, thank you so much for coming on the pod. I really appreciate you. Truly, truly, truly. Tell everybody where they can find you.
Well, first, before I do that, I just want to say it's been such a journey and an honor to watch your journey over the past, I think we met 9 years ago.
Aww.
So watching, when you talk about resilience and pivoting and figuring things out, it's been just a pleasure to watch. So
thank you, Jewel.
Thanks for having me. I feel like this is a very full circle moment for us.
Thank you, Jewel. Air hug. Awesome.
Yes, but folks can find me. Collab.capital is our website. We have an open application on our website. So if you are building a venture backable business, feel free to apply. And then I'm Jewel Melanie on all socials.
Awesome. Thank you guys so much for tuning into the More Rounds podcast. I'll see you guys in the next episode.